We've spent a lot of time in the last few days talking about this very strange and slightly tumultuous period of boom, bubble, and bust that we've gone through over the last few years. And you've been talking about how a lot of very smart, successful fund managers, including close friends of yours and mine, got sucked into a lot of these companies that seemed crazily overpriced but were very high quality. In some cases, at least very high quality, or at least very promising. And so we're here at this conference of yours, ValueX, where a lot of people come in from around the world, and it's kind of a nice barometer for the mood. And in recent years, you would have people coming in and talking to you about why you should buy a company like Snowflake at 100 times revenues. And it was difficult. It's been a tough time. And you had people telling you, here's what's so wonderful about Cloudflare or Twilio or Carvana or Roku or Spotify or Netflix. And I'd like to talk for a while actually about this strange period and how tempting it was, how intoxicating it was, how destabilizing it was, and also how you ended up resisting a lot of the temptation to pile into this stuff that was really very seductive because it had worked for several years. It was the way to make money.
Yeah, and where that starts for me is at the very, very beginning of lockdown. And I remember being in Zurich, and the share prices of some of these businesses that would benefit from lockdown, but were all in the cloud and were all this kind of SaaS type business model, were absolutely soaring. And one of the ones I remember was Zoom. And of course, we were all starting to use Zoom, and I'd recently signed on to Zoom maybe in the year before. And and the people who happened to have been in those businesses looked like utter geniuses. And I had always shied away from technology in general, but especially software companies that had, that were spending an enormous amount of money to grab market share was the argument. And I remember that I was invited to a lunch with Eric Schmidt, with Monish, and actually a student at Stanford Business School. Felt very privileged to be invited to the lunch. And Eric Schmidt just took it as an unquestioning rule of business that there was these new businesses is that there was market share to be claimed or land to be staked, a bit like the American frontier west, where they just let people ride as far as they could, and all the land that they could see would be theirs. And any amount of money that you spent to do this land grab was okay.
And Schmidt, just so people know, he had run Google, right?
He was the chairman of Google at the time, so he was no longer the CEO, I believe. And so I was kind of struck, actually, by, we hold these truths to be self-evident. There was no other way to work in business. I mean, and then there were people from my world, the value investing world, who had invested in such businesses with metrics and valuations that didn't make sense to me. But they were being proven right, especially through that COVID period, where the share prices of many of these businesses absolutely soared. And it went to companies that maybe didn't have this sort of cloud winner-takes-all, winner-takes-most component, like Peloton, for example. So I remember that I changed my password because I was still in a mentality of other valuation models for which these kinds of businesses would be cast out immediately. And so I really spent quite a bit of time telling myself, Guy, you've missed the boat. You're missing the boat. FOMO is something that spreads like wildfire through a population. I remember that I changed my password. So I often use passwords that I have to remember. I use them to kind of self-hypnotize or to remind me of something. So maybe it's to have a positive attitude or to be happy or to take care of somebody. It's a wonderful way to kind of influence yourself because you keep having to bring it up and it kind of works its way into your subconscious. So I changed my passwords to remind me that I had to learn about these new rules of business, if you like. So that's the degree to which it got to me.
So what did you change it to during this heated period? Because I remember years ago you had Warren as a password for one for one website. And so I guess that was a way of you kind of tilting the odds that you would behave in a high quality, long-term way.
Myself. And for a certain period of time, because I felt like I had blotted my copybook through my experience at DH Blair, the passwords were, or they had an element of trusted in them. So I wanted to be trusted. So I just wanted to work that word into my mind. I want to be trusted. So it would be trusted everywhere. And so, I'm sure that this is not very good from a password security standpoint. And there may be one password that I will have to change right after this conversation. It's an element of
There are only
phrase.
A few 100,000 people listening. You're
Exactly.
you're okay, guy.
But I'll have time during production. But the phrase was new economy.
Huh.
And so rather than, and this was part of a longer phrase, but rather than ignore it and say, this is not a place that I need to ever look for investment ideas, to remind myself that this was something that I had to engage with seriously. And there was, Hamilton Helmer, I think is his name, The 7 Laws of Power, How to Get Power in Business. I'm mangling the name of the book, but I read that book 2 or 3 times because it was relevant to the kinds of shifts that had taken place, for example, when we had Netflix and over-the-top services. And this was, again, something that I had completely failed to focus on. But then whenever I dove into, so I had that going on, and in a certain sense, you can say, I think that if I look at my mind, so that whatever it was that was spreading like wildfire and a way of looking at the world, and then accelerated by lockdowns, and some of these businesses really did get a tailwind to their businesses and soared. And then, of course, I've got my password changed. So now I'm saying, no, take these businesses seriously. Look at them carefully. Try and understand if they are actually, if you understand them correctly, they are actually cheap. And it was extremely frustrating for me because I had pounded into myself enough over the previous 20-something years valuation criteria that I just couldn't get there on any of them. And it's not like I wasn't trying. And for example, in the case of Netflix, I saw these prodigious cash flows, and I saw the subscriber growth. But at the same time, I saw them spending an enormous amount on content. Not only that, there was at some point where they did not do a share issuance, they did a convertible bond issuance, and all of this money was going into content. And so the big question arose, at what rate should this content be amortized? And the company was being valued as if it didn't have to be amortized at all, meaning that the library was an evergreen library that would continue to generate the revenues that it was generating. And those seemed to be heroic assumptions to me. And for what it's worth, at one point I rejected Disney for the same reason, because in these content companies, they're just sinking a huge amount of their free cash into movie assets, which are kind of these random assets. Some turn into a franchise that lasts forever, like Star Wars or Aladdin, and others turn into something that was watched once and is rarely watched again. And if you just don't know where on that spectrum it sits. And in other businesses, some of them weren't even cash flow positive. And so you had to go, Michael Mabusian has this wonderful piece where he talks about how to analyze businesses based on this idea of unit economics. And unit economics, in a certain way, we talk about, Charlie Munger talks about how EBITDA is not a real measure of earnings. And this takes you one step further.
Use a ruder term than that.
That's true.
Beginning with the word bull.
Yeah, and yes. And but you're going one step further and you're saying, actually, free cash from operations doesn't matter. The only unit of analysis that counts is unit economics. So what is the cost of customer acquisition and what is the lifetime value of that customer? When you're talking about lifetime value of the customer, you're making assumptions about what's going to happen over the next 30 years. That is an extremely long time. In businesses, which traditionally technology has been something that you can easily or over time constantly gets competed away by innovation. So can you really rely on those? Now, on the other side, it only dawned on me way after other people, and it was frustrating for me because I had friends. I'd gone and given a Google talk, invited by Sarab Madan, and I'd gotten to know people who worked in Google's cloud business. And what we understood from Amazon was that these cloud businesses have amazing moats, because once you're locked into that particular cloud, then it's very, very unlikely that you're going to want to shift. So a lot of these businesses, especially with the soaring share prices, the people who said, well, unit economics is the way to do it, were being proved right. But I was enough of a dinosaur, let's say, that I didn't feel safe updating my valuation models to that degree. And there's something where, I think I brought it up to you over the last few days. If I go back to those beautiful days after the financial crisis when Monish calls me up and he says, there's this amazing CEO and he's running a company called Fiat, and Fiat's got a $4 billion market cap and $120 billion in revenues. And so you kind of say, if this company can earn 1 or 2 or 3% on those revenues, which is a perfectly reasonable thing to expect, then this thing is potentially trading at only 1 times earnings or not far from 1 times earnings. And that is a very, very safe, low to the ground valuation, which is grounded, if you like. And then you have these things which are kind of so far away from the underlying cash flows, and you're kind of relying on these analyses like unit economics. And despite being desperately wanting to be able to say to myself that this made sense, I would find myself disappointed and in a way sort of my heart sink. I remember listening to a podcast with the CEO of Roku, and I discovered on that podcast that Roku this man had a very close relationship with Reed Hastings, that Reed Hastings had invested in Roku, and I understood what Over the Top was doing, and I myself saw how little I was watching, say, cable TV, and how much I was looking at these various apps that appeared on my TV and allowed me to stream all sorts of things, and that Roku was at the absolute center of this. And so I would excitedly then bring up the accounts of Roku, and I'd just be utterly disappointed to discover that I was looking at a $40 billion market capitalization and revenues of less than $1 billion. And with that, I was just almost unwilling to look further. The idea of walking down into that cave or walking down that path made no sense to me at all. And so I was stuck there, and I wasn't able to invest in them, while the people who were invested in them looked smarter and smarter and smarter. Just, an interesting sort of question for any analyst or anybody who wants to succeed at doing fundamental analysis is to ask oneself, when do you stop and start searching down a different path? And there's a question, should I have gone further down the unit economics analysis framework? Should I have spent more time looking and understanding Roku, or Cloudflare is a similar kind of story? On the other side, and something that Monish has taught me a little bit to do, but I really could go much further, is that we often stop searching at the wrong point. And I think that it behooves me to go a little bit further despite the apparent high valuation, just to see where the analysis comes to and to try and understand a little bit further. I think I probably stopped too soon, but it's kind of unbearable to me. I'd trained myself not to do that. On the other side, I think that there are, if you take the Fiat example, I would have stopped the analysis and said, yeah, but it's loss-making and the automobile industry is going through wrenching changes and this company nearly went bankrupt. So there are all sorts of reasons to stop the analysis from that side. And what you need to do is keep going just to see where you get to and to see if there's subsidiaries, for example, that, in the case of Fiat, even if you assumed, which wasn't the case, that the whole of the traditional automobile business was not worth anything, they had this jewel called Ferrari, which anybody who held the spun out shares of Ferrari has got multiples of our original purchase price just from the spun out shares. So sometimes something looks really ugly and you have to go further down the road. I think probably you're better off going into something that looks really ugly and seeing what's underneath and pushing your analysis through on that side, then trying to find reasons to sustain a valuation that doesn't make any sense. But on either side, one should not cut one's curiosity and try and push through further.
Why do you think these friends of ours who are really smart, really thoughtful investors got seduced and were able to suspend disbelief and suspend skepticism? And I'm wondering slightly if in some ways it was that they learned the wrong lesson from the success of people like Bill Miller and Nick Sleep in buying things like Amazon that were very high quality and seeing value in a different type of company. If in a way they took some lesson from that sort of behavior and then forgot that Bill and Nick had bought things like Amazon incredibly cheap and then managed to hold, they saw the quality and then rode them for many, many years. What do you think? Why did people suspend their disbelief? Who these are really talented investors. Yeah. They're not mugs.
Yeah, and I think that where I go to at its absolute core is that the one thing to be really clear about, I believe, is that any one of us is susceptible to this, including Warren Buffett. The idea that a human is not susceptible to these moods or whatever it is that takes over, I think, is a very, very bad conclusion to draw. We're all susceptible to it. And another way of looking at this very, very unusual development in human history is this concept of markets and stock markets and a price for some commodity or some asset whose value is disseminated across a population. I mean, we certainly didn't evolve with that. We all know about the fact that our minds evolved to taste the berries and react positively if the berries didn't kill us and react negatively if they tasted bitter or did kill us. There's this very, very weird interaction that happens between stock market prices and human psychology, and the underlying businesses that drive changing economics are in themselves changing. So the economics of the cloud, which is a new kind of economics, has never interacted with the human mind before. And I think that we need to understand that the stock market and sort of public markets are constantly changing interactions between prices, psychology, and the underlying economic environment. And it will constantly test the human mind in aggregate to find something that works. And so sooner or later, you've got this constant machine that is going to find something in enough human minds that when it's spread across them results in price action and reinforcements of things that kind of like are extremely unusual for a certain period of time. And this interaction between prices and psychology leads to this huge divergence between what is going on between the psychology and the price action and the underlying reality. So I think that my kind of like, I hope it's a useful answer, is that will take over any human mind in the same way that we can say that, the virus, any kind of biological virus, doesn't really make a distinction between, say, race, doesn't make a distinction between intelligence, it doesn't make a distinction between wealth. And you and I know that it's one of these strange equalizing factors and a great weakness for very, very smart people is that if you've been through the university system, if you've done well at exams, if you've had all sorts of experiences that lead you to believe that you ought to be able to be successful, say, at investing, you come to believe that there are certain things that you're not immune to. And I think it's hard, especially for smart people, to really make ourselves aware that we're, in a sense, more susceptible to these market moods because we think we're so smart that we don't need to pay attention, if you like. So I think that's a kind of like trying to attempt a very, very basic explanation, which in fact doesn't explain much. It's just saying there's a weird interaction between psychology, prices, and underlying economic reality. But then I think that if you want to dive into more of the weeds, it's something along the lines of what you're talking about, that, a brilliant guy realizes that he can, that it started with Costco, that Costco, despite appearing to be expensive, was really very, very cheap. He then has the realization, and I'm talking about Nick Sleep and Costco, along with Zach, and then he has the realization that actually Amazon is Costco on steroids, and there's plenty that's been written about this, and he gets it right. And you're absolutely right that Amazon was never, in a sense, not profitable, and it was a point that was made to me recently by Nick, that even at the time when the share price had declined dramatically, what they were doing was they were taking operating profits and pouring it into new businesses. So they had internally funded growth from a very, very early point. And some of the companies you mentioned were all externally funded growth. They were being funded by the capital markets. But if you study Nick Sleep, and it's in part my job to study what brings success to investors and to understand new approaches to bringing success in investing, then a natural thing to do in my shoes is to say, well, Nick found Amazon. How many other analogous investments are there? And I myself have had great success by looking at business models that have been successful, say in the United States, and applying them in other countries, looking for credit rating agencies in other countries, looking for for-profit education companies in other countries, or branded goods companies in other countries. And so it would have been very natural for those of my ilk to say, what other Amazon.coms are there out there? But in the same way, perception is a weird thing. So you're looking for those qualities, you think you understand them, and then you go into another business and you think you found them. Maybe you have, maybe you haven't. I think that a lot of the madness was that people really did believe that they'd found them, but actually they hadn't, because there was only one Amazon, or very few. In the same way that maybe somebody sees one successful automobile company in the turn of the century, but most of them ended up going bankrupt. So it's a complex story, but I hope that helps to some degree to maybe give some kind of an explanation.
It also gives a sense of just how hard the game is, that you're trying to see patterns and extrapolate from them, and learn from examples of success, and you have to do it with a tremendous sense of nuance. That it's our gift for pattern recognition can also get us in tremendous trouble.
Yes, and so this thing just turns on itself constantly, and maybe I know that you brought this up to me recently. It's one damned relatedness after another. There are also clearly sort of sweeps of market history. So we were coming out of a period. It's amazing for how long the Ben Graham discount to book value, or discount to 2 or 3 very simple measures, buying the lowest decile in valuation, worked really, really well. But it worked, and this is coming out of the Depression, when all sorts of companies, nobody wanted to invest in the stock market. All sorts of companies were trading at discounts to very simple measures of liquidation value. And people like me, and many other like me, sort of just wished for the days when all you had to do was find one newspaper towns. But that was working less and less well. But what was extremely successful, starting with Warren, was looking for these better businesses. And you have Rain Cunniff and other firms looking for better businesses. It's a very natural progression to go from looking for better businesses, high returns on capital, high returns on incremented invested capital, not looking for, say, book value, but valuing the brands inside the business based on their intangible value and not tangible value, because if you try and liquidate the brand, you're not going to get anything. And then take it yet one step further into unit economics, lifetime value of the customer. And I remember with a good friend of ours going through the valuation of Salesforce. And Salesforce invests an enormous amount in marketing. They do these, I don't remember what the name of the conferences are, but they're incredible events where they invite speakers. I've attended one in New York City, thousands of people attending, some amazing brand name speakers there, amazing opportunities to learn not just about, at its core of those conferences, how to implement Salesforce in your business, but how to improve your life in any which way. But in order to reach a reasonable valuation for Salesforce, at the end of your value of your model, you had to take away those marketing expenses. You assume that they're no longer necessary, and you have to make huge assumptions about how many customers leave you every year, because that sort of determines the life cycle, how much you've invested now for the revenues that customer is going to generate. And you had to make, well, we will discover whether there were heroic assumptions or not. Maybe there were not heroic assumptions, but I ended up having a debate in my own mind whether the assumption was heroic or not, and that the decision as to whether that company was cheap or not would have actually turned on whether the assumptions in the model were generous or conservative. And that's a whole new world that seems to me to have been kind of a step too far, at least when it comes to value investing and getting more, now that I'm listening to your podcast, Fred Martin, who's repeated this word in such a beautiful phrase in such a beautiful way, price is what you pay, value is what you get. And the definition of value, ultimately, you can have it in your mind, and a false valuation model can be reinforced in the market because of the price action that makes you look right for a number of years, makes you look smart, but then eventually gravity pulls it down to earth and you discover what value really is.
You mentioned to me the other day that you've come out of this period with a couple of new checklist items, and you also talked about how you were protected by being in this ecosystem where you were reading things like Tom Gaynor's annual letter. Can you talk both about the checklist items that are practical ways to protect yourself against these kind of temptations, and also how putting yourself in a certain intellectual space and a certain ecosystem also is a key way of protecting ourselves from getting too carried away?
Yeah, so the checklist item is an interesting riff on something that Warren Buffett has said. So we all know that Warren has said that he would not mind if the stock market was closed for 10 years. His valuation and his confidence in the value of the business is not reinforced by any particular price action or any particular quote. He looks to the results of the business. What are revenues? How much cash is it generating? What are owner earnings? All of those good things. But what I realized when looking at some of these companies that were investing in the future of their business, not from operating earnings, but from money raised in the market, either through equity offerings or through debt offerings. And many of these companies had originated inside of venture capital firms, where the venture capital firms would have fueled their growth by putting their partnership money into those companies. But then that it seems like that continued in the public markets, and there were plenty of investors who were willing to show up based on their unit economic analysis or revenue growth and all sorts of other numbers to continue to fund the growth of those companies. So they're taking money from the capital markets and they're investing it in operating losses because they're going for this they believe that winner takes all or winner takes most, and they want to grab market share, and everybody believes this. And all of this is wonderful until the music stops and the capital markets aren't willing to fund your growth anymore, which seems to have happened for many companies in 2022. And then the company has to do some huge reorientation because they have to restructure their business model based on internally generated cash flows. And what it seems to me is that in many cases, at that point, what appeared to be growth capex or growth expenditure was actually an operating cost of the business. And the internal accounting up to that point implied that the business was profitable because they could characterize these new flows of capital coming in from the capital markets as capex. And suddenly maybe it's not capex, and maybe actually all the business or aspects of the business are actually not profitable. And so the simple checklist item that comes up is, can the company fund all of its growth and all of its discretionary investment in potential new businesses from existing cash flows? And in a certain sense, what I'm saying is that venture capital is a world that I respect it deeply. There are people who do it really, really well, and it's spilled over into into public markets. But I very much want my investments not to be of the VC kind where capital markets are funding growth, but where growth is, if it's being funded, is being funded internally. So the simple question is, can the company fund all of that from internally generated resources, i.e. it can continue to grow, even if the capital markets were closed. They don't need to rely on their interactions with the capital markets.